welcome to TheoTrade. This is Don Kaufman. It's February 21st, 2020, and you are watching the TheoTrade Weekend Update. Fear is coming into the marketplace. You know, this week, which was a holiday kind of shortened week, started off pretty mellow. You know, fairly mellow Tuesday after, of course, Monday, President's Day, the market was closed. Markets did the same thing they've done day in and day out on Wednesday with a grind to the upside. But coming into Thursday and Friday, a couple of things just got downright ugly. And I think this changed the way a lot of people right now feel about the marketplace. Let's start to knock out a couple of bullets that I want to talk about specifically on this weekend's update. I'm also going to get into a vast number of opportunities that we see coming in the very near future. One of the first things to be pointed out about some of the price action that we've seen, hey, listen, this is really just the last two trading days. We just found out, well, we can move big. And everybody's on notice at that point forward. What do I mean by that? Again, this is one of the critical takeaways from this week of trade. All right, I'm actually going to go into the S&P futures, and I recognize that not everybody necessarily trades S&P futures, but it's neither here nor there, okay? When I say we can move big, I'm not referencing this price action today, all right? By the way, we're just a few moments past the cash close here on a Friday afternoon, okay? Today, this was a very, again, grinding kind of day to the downside. We'll talk about the expected move. But, today we didn't have any, wild, outlandish kind of price action. However, on Thursday, well, a lot changed for me specifically on Thursday. And for that, I'm literally going to take the time and zoom back to it because I believe that this is a critical move that is going to pertain, okay, to possibly the not too distant future, because I'm saying fear is coming into the marketplace, and it's a fairly large statement. But a bigger statement, you better recognize this can be a big boy move in a very, very short period of time. Again, what I'm referencing is the move that we saw on Thursday. That move started right around, okay, 33.90 inside of the S&Ps and took off all the way down, okay, to roughly, well, where we're kind of dead flat into right now, which is 33.40. How ironic that is the final resting place of the S&Ps. All right, net, what do we see? Oh, less than a 30-minute window here. We had a 50-point move inside of the S&Ps. This is not, okay, me barking about being bearish in the marketplace. You've just seen what I would term the bidless beast kind of, unleash. I'm going to explain precisely what that kind of terminology means, at least to me. The bidless beast, though, was upon us when you're seeing, again, very methodical sell-side activity and nothing less than just stellar contract size. But this, okay, bidless beast, as I'm calling it, it was felt everywhere. All right. You could point out in terms of like Apple, okay, bidless beast, huge spike in volume. You could feel it in every major underlying, okay, and it has everything to do with correlations kicking in the marketplace and there being no place to hide. Now remember, I'm saying that right now, okay, just on the, on the peripheral, and we'll bring this back into scope in just a moment. You got to remember now moving forward, we have the capacity to move big. It's going to drive a lot more fear in the very near term in this marketplace. The next point, not much more to say than this. The coronavirus, it's just not going away, right? This was a fear that, well, kind of died out a little bit last week. Well, all of a sudden, front and center. This was actually the topic of conversation that I had in last week's video. Literally last week's video was all based around, we looked at the marketplace and said, listen, there's imminent risks out there, okay, that are just not being addressed. It wasn't like, the volatility was indicating like we're going to, duck and cover. Nothing to do with that, okay? Things like, and I'll show you here, I have an LVS position. And the LVS position we took specifically based on what we learned last weekend's video in Las Vegas Sands. And the reason that I wanted to bring up Las Vegas Sands in this context of the coronavirus, listen, there are, umpteen different ways to probably trade the coronavirus, okay? And neither good nor bad. There's umpteen different ways to do it. Why I like Las Vegas Sands more than almost any other position out there, okay, had everything to do, just look at the company profile. Everything has to do with Macau, Singapore, okay? I mean, Las Vegas Sands, what does it have to do with Las Vegas right now? And the answer is, here it is, about 5% of the business. It's negligible, okay? This, okay, dropped heavily on the onset of the coronavirus and bounced beautifully. So what did we do? Oh, we actually came in and we put on a short position in Las Vegas Sands, but we did it using a deep in the money put. We didn't go out and outright short the stock. Why? Why take the risk? Moreover, I'm in my IRA, so why take the risk in the IRA? Because I can't short stock. So I used a deep in the money put, and that deep in the money put, we put this trade on, again, just a few days ago, and here we are, again, seeing some fairly heavy sell-side activity with more expectations of downside, specifically inside of Las Vegas Sands. But the coronavirus, again, there's umpteen different ways to trade this. It's not going away, okay? But I'm going to show you more trade opportunities, okay, that maybe you're not necessarily seeing here in a few minutes. The next thing I want to bring up and into scope over here is PMI. So the PMI flash came out today. Now, when PMIs come out, they typically come out all over the world. Europe had actually relatively good PMI. I sound shocked by that because I am. The PMI was not half bad in the Eurozone. Okay, great. Nobody really cared. I mean, like if you looked at the, German markets, which I'll bring up here towards the bottom of the screen momentarily, look at the German markets. They didn't care. They still sold off. Okay, neither here nor there. Nothing too big. But the interesting thing came in the U.S. PMI was terrible. It's actually the composite PMI is the lowest. Again, the composite PMI, and I'm going to highlight this for just 1 second on your screen, so make sure you see it. It's the lowest since 2013. The flash U.S. Composite Output Index was 49.6. Now, for those of you who know a little bit about PMI, under a reading of 50 is construed as contraction inside of, again, composite PMI and economy. It's now a 76-month low in terms of a PMI reading. All right, I'm going to push that aside for a second. All the PMI really did today, and I want to show you precisely when it came out on an intraday basis, right? So the marketplace opened here. Now I'm on Mountain Standard Time, so our marketplace opens here at about 7:30. Great. When did the PMI actually come out? It came out about 15 minutes after the open, and 15 minutes after the open, there's the PMI. Listen, the sell side activity was already rather persistent before the PMI number came out. So what's the difference? Like, why should we care? I'm going to tell you why you should care. Because the bonds, okay, took off to the upside on this, and the ZB exploded all the way to the 165 and 22 ticks. Now it contracted a little bit, but again, bear with me. We're going to talk about some of the bond market here in just a moment. Okay, the PMI number though kind of felt like the marketplace had already maybe priced it in. Once again, though, this marketplace has been shrugging off all news, any news. All news is good news, right? So let's just move forward from there. PMI numbers, not great. This is important. SPX expected move. Week in and week out, I detail the expected move. Listen, if you're not into the expected move at this point, you're just completely missing the boat, okay? Each and every week, I detail this throughout the course of the week. It's all right now about the SPX. It's all about the SPX. A moment ago, I was actually detailing specific levels inside of the S&P futures, and how ironic that the S&P futures are sitting at 3339.75 right now. Okay, and technically they're still open, right? The S&P futures are open until about a second ago. They literally just closed. Okay, 15 minutes after the bell, they just locked them down. Okay, where was the edge of the expected move this week? Now my mouse happens to be on it. And again, I'm gonna go into this, all right, on a daily chart, and I want you to see the edge of it was roughly speaking 33.41. it was, and again, I can highlight as close as I possibly can into here, 33.40, 33.40.79. That was effectively the edge of the expected move. Okay, but the SPX, okay, and you have to put a handle on this. It's a $3,337 product. It missed hitting a line that I drew on my screen a week ago by what? By 3 points. It's really less than 3 points, it's 2 points. Okay, it is absolutely phenomenal. It's driving all over the trade right now. If you take a look on an intraday chart, okay, you're getting wild sell side activity. And I started off today, and I didn't, not the intention of driving fear, but fear is coming to a theater near you, except that fear, okay, drove us to a specific level. We stopped literally on the level and bounced off of it. It is uncanny how effective the SPX has been. And the reasoning for this, and I'm actually going to take you over to the SPX for just a second. A lot of the reason for it is the sheer magnitude, the size. The SPX did almost 2 million contracts today. Almost 2 million contracts. The entire marketplace will probably do, today's a pretty heavy day. I'm going to guess the market will probably do 30 to 35 million contracts in terms of total option contracts today. But 2 million of them are pretty much coming from the SPX. The only difference is the SPX is about 10 to 20 times the size of every other product. So these contracts, okay, are like 20-fold more important than any other contract. So it's great. The marketplace traded 30 million contracts today. The SPX did what? Okay, 2 million times maybe 20. Okay, what I'm saying is the liquidity. All of this notional value. Notional value is how much, money's actually running through the marketplace. It's all running through the SPX. And by the way, the spiders are basically the same thing as the SPX. So when I'm talking about 30 million contracts, yeah, guess what? The spiders are good for 5 million too. So there you have it. You have 7 million contracts. 7 million contracts that have traded today out of 30 million that are all directed towards the expected move. But wait, there's more, because the VIX is also, in effect, what? Well, it's related right to the SPX. There's good for another 500,000 contracts. Everything on your screen right now is related to what's going on in the SPX. And you wonder, how is that even possible? I'll tell you exactly how it's possible. It's expected move. Okay. The line on the screen is critically important, which actually brings us to next week. So this last week, which is a holiday week, was only a 4-day week, right? We were expecting a $39 and change move. What did we actually get? Well, the $39 move was to the edge, which was $33.40. We moved $2 past that. Okay, but we have a little bit of an issue starting to form here. And here's the issue. You got 1 week, we cracked the upside. 2 weeks, we just came off the downside. Okay, 3 weeks, we came off the downside. 4 weeks, big crack to the upside. 5 weeks, there was a slight breach last week. This is technically, okay, a very slight breach. Minimal. As I said, one of the things, okay, that we've theorized for quite some time, and we've been studying expected moves now for years. In fact, right here, that's 3 years of data on expected moves. All right. One of the things that we've studied is the marketplace has tendency to go from periods, okay, of incredible efficiency to periods of relative inefficiency. Right now, we are inefficient. Now, I'm going to make a fairly bold statement. Expected moves are projecting extreme risk right now. Option markets, they are completely failing to accurately handicap expectations. The reason I'm saying that is if you look out at this next week of trade, a moment ago I was like, it's $55. Look at this. The expected move is down to $54. $54. Okay. Are they mad? Are they crazy? We moved that pretty much today. What do you call a $54 move? You call it today. From high to low inside of the futures, they're moving that every single day. And these monkeys keep the volatility contracted. So if you ask me, should I be buying option premium? Should I sell it? What do you think I'm going to tell you? Okay, you got to be a buyer of premium. You got to be nuts to sell options in this marketplace, especially in the short duration. All right, moving on from there. So, okay, you got to expect now that you're going to get, and you need wicked moves. All right, the point, the big takeaway, and the reason I'm spending so much time in expected moves, the biggest takeaway from those expected moves, we need to see something hideous happen. Okay, we need to see something hideous happen because they're keeping the volatility. It's almost like suppressed. They're keeping a blanket over the top of the head of volatility right now. And I'm going to further that with this, the VVIX. Let's go to the bottom of the screen, go to the VVIX. The VVIX is the volatility index. The VVIX, it is just shy. And again, I want to show you this. It's just shy of duck and cover levels. You know, when the VVIX gets into this territory of about right there, that like 110 turf, okay, it's serious at that point. But usually by the time of 110, it's so serious that everybody knows it. They're like, everybody knows it over there. Okay, but we're just shy of that. But here's the cool thing, right? The volatility futures, they haven't really followed suit. If you take a look at the volatility futures, we haven't flipped over. You know, people talk about contango and backwardation. Okay, here's the bottom line. 26-day volatility futures, all right, just shy of 17. When you look out at the 54-day volatility futures, they're still what? At 1730. The warning sign is when the 26-day vol futures exceed the 54-day vol futures. And people, we ain't home yet. So move along over here. Next thing I want to talk about, bonds. They've just gone parabolic. Now, listen, you don't have to look at a chart to know this, right? The bonds, they're straight up. But with the bonds, the influence they're having right now, okay, upon the TNX, we're looking at interest rates that are not just multiple year lows. I just want to show you, this is the TNX. The TNX is representative. I'm going to pull up a maximum chart now. The TNX is representative of the 10-year interest rate. When it says 14.7, that means 1.47%, right? We're pretty close to the all-time lowest recorded interest rate ever on the 10-year. But there's a bit more on this front. On TYX, it is the lowest recorded ever today, ever in the history, okay, of the TYX. And the reason I have this maximum chart available, want to know why I have the max chart available? I don't know about you, but I think I'm starting to see a trend, okay? It's the race to zero. It's the race to zero. Do I think that the 30-year is going to zero? No, okay? But it's the race to zero. And I think we're going to continue this trend. This is not, you know, in any way, shape, or form, this ain't a positive thing, okay? For the market, it's not a positive thing for the world. It's actually why I'm bringing it up. It's hideous, okay? And I'll tell you exactly why. It leads to the forcing the Fed's hand. Lower interest rates, they're coming. Okay, why? Why are lower interest rates coming? And I'm going to spend, again, 2 seconds on this, but I want you guys to understand. What you're looking at right here, this is actually the Treasury's website. Okay, this is the U.S. Department of Treasury. I just refreshed it because they're actually going to have today's interest rates on here. They just refreshed it, and it's looking at the entire yield curve. I'm going to do a 2-second explanation of this. Taking a look at the yield curve, okay, there's the 10-year. Here's the 3-month. You with me? Okay. The 3-month is trading for roughly 1.56. The 10-year is trading for 1.46, meaning that, yes, the 10-year is actually lower than the 3-month. Well, so we have an inverted yield curve. And some people, they look at like, this is the 2-year versus, for instance, the 10-year. All right, they're really close too. But there's one thing and one reality here, and that's this. Okay, nobody wants to hear there's an inverted yield curve because that means there's a recession coming. So what do we have to do? Oh, the Fed. The Fed to the rescue. What's the Fed going to do? The Fed really controls these shorter duration interest rates. So the Fed fund futures right now are what? 150, 175. They got to take them down. They're going to take them down. They're going to take them down to the neighborhood of 125, 150. They may even shock us. If coronavirus really picks up, they may come out with a special cut. They have to take these down. They got to take them down to get them back into a line and under. You got to get short-term rates under longer-term rates, normalize that curve. Because if you don't, it's only a matter of time. It's only a matter of time before what? Financials start to fold. Okay, we start to get liquidity seizures. Repo markets are going to be nuts. You name it. Okay, they know it. By the way, when we start looking at, this is the CME Fed Watch tool. When we start looking at the probabilities, okay, you don't believe me on the Fed? Yeah, look at this, okay? There's only a 30% chance. That's out by June. I actually believe we're probably going to be cutting as early as April. You may see an interest rate cut as early as April. If coronavirus picks up, they're going to cut even before then, okay? Yeah, interest rate cut coming to a theater near you. So be aware of it. Now, interest rates, where is that going to ultimately cause? Well, people might think that that's going to be positive for the marketplace, but sooner or later, and the reason that I'm throwing this up here is my belief, eventually, you're going to turn your back on the Fed. And that's when things are going to get downright hideous. Now, to the bidless beast. I just want to spend a moment on this. I want to come back and circle back to the market move that we saw on Thursday that I called the bidless beast. Okay. We've all seen this before, but there was something vastly different in here. There were some big time stocks that just were not, okay, there was no bid in sight. I mean, the marketplace was just drop. Okay, there's no bids in here whatsoever. And there's a period of time of almost 10, 15 minutes. There was no uptick here in the S&Ps. And again, you could find this in any given stock. I don't care whether you look at Microsoft. You want to go look back at Microsoft the same time period. They all look absolutely identical. So a couple things to keep in mind. If we start to see some sell side activity in the next few days, few weeks, let's go out even a month. If these markets start to sell off, okay, there are two huge reasons and causes for concern. All right, and I'm going to keep this short and sweet because I'm going to mention it a lot more during this next week here on TheoTrade. Stock buybacks and passive investments. I'm actually going to start bottom up here. Passive investments. We all know that passive investment is larger than it's ever been before in the history of the marketplace. Effectively, what I'm saying is, okay, everybody owns stock. Everybody owns the spiders. Everybody owns the ETFs. Okay, if there's sell side activity to the broader marketplace, those passive investments have to be sold off. What do they have to be sold off? Redemptions. People sell the spiders. Okay, the spiders have to turn around then and actually sell the individual components of the stock. If people turn around and want money out of their 401ks, there have to be redemptions. There's going to be sell side activity. Passive investments, probably responsible for a lot of the rally that we've seen, but we've never seen passive investments in the history of the market as deep as we have right now. Next thing I want to talk about, stock buybacks. Okay, neither here nor there. Who cares, Don? Okay, these companies are going to still buy back their stocks. Maybe. But I'll tell you right now, if you start to see sell-side activity, I want to remind you that when you look at a stock like Microsoft, when you look at a stock like Apple, okay, they've been buying back up to, okay, about 10% of their stock, like volume per day, is them. So when you start looking at like Microsoft stock, okay, up to, again, an average of, they have to average under 10% of the total liquidity inside of that marketplace, okay, of Microsoft is due specifically to Microsoft buying back their own stock. You know, they always say if you speak enough crap, you'll start to believe it. You believe your own crap. Well, they're buying back their own crap. They start to believe it. There's two major issues with this. When the marketplace starts to sell off, okay, 10% of that liquidity may not be there. Why? Because they're only on the bid. They're never going to be a seller. They're only on the bid. Now, you may think that that's a good thing, okay, but there's no one to support, okay, the downside to it. There's no support. And if the stock buybacks were to dry up, obviously you could see some of the issues over here. What I'm saying, though, is that a huge amount of the up moves over here are supported exclusively by stock buybacks. Okay? Are those stock buybacks going to support sell-side activity of passive investment? Of course not. Okay? So there's nothing, and it becomes a bidless beast. More an explanation of the stock buybacks specifically as we come into this week. Now, if markets, if they continue to weaken, look to short unscathed sectors and stocks, right? Real quick, because I want to give you a first example. I was actually watching this earlier today. Lululemon, okay, actually opened higher. This is what I mean by, again, this is not one of the stocks that would jump out and short, but this is what I mean by short unscathed stocks and sectors, okay? Look to hit what's strong in weak markets. If the markets continue to get weak, look to short unscathed stocks and sectors. Here again, the preeminent example, Lululemon today, completely unimpeded, even after having news. Don't worry, all their China stores are shut down. Okay, I mean, this thing, it had me looking all throughout the course of the day. I've got positions in here, and all of a sudden, yeah, started to feel some sell-side activity. Okay, look at other stocks, and I wanted to compare something to it like Nike. Right? Nike, not dissimilar in terms of the intraday move, but Nike still near an all-time high. Okay, what else do we have? XLU. Listen, if they start to hit this marketplace, you're thinking, this is a safety trade. They're going to go into the utilities. They're going to go into the utilities because they're paying a 2.85% dividend. I don't agree, okay, completely with the fact that this is not going to remain unscathed. Yes, okay, initially we're going to pile into something that pays a 2.85% dividend. Nevertheless, okay, when redemptions come, if this marketplace starts to sell off, they're going to hit everything. Start to look towards sectors that you think, okay, are areas of safety. Start to look to what's predominantly considered low beta. Look how low beta that is. Low beta, I'm telling you right now, in big volatility, low beta is actually going to be huge risk. Look towards XLP. This is consumer staples, okay? Consumer staples, been a freight train to the upside, unstoppable beast. Look towards things like Walmart. You think that these things are going to be unimpeded? Absolutely not. Look towards things like, how boring of a stock is this? Colgate-Palmolive. Ooh, today it was actually up big, almost 1.5%. Last but not least in this one, okay, and I really like this, trains, planes, and automobiles. I've carried a short position here. I've taken some heat, okay, but I'm going to tell you right now, CSX, come on. I mean, what are we talking about here? The latest, greatest tech company? No. They've got a train. How's that going to look in a really down economy? Not well at all. Again, if we continue to weaken, this is where you start to fish out. This is where you start to, again, dig in right now. Dig in, right, and find areas that are what? Unscathed. With that, I want to thank everybody for joining us here at TheoTrade on this weekend's update. Please stay tuned for this very important announcement. Hey, it's Don Kaufman here at TheoTrade, inviting you to join us live here in Scottsdale, Arizona for the TheoTrade 2020, the Decade of the Trader. First of all, our VIP is already sold out. Our first deal is sold out. We do have our early bird open. Now, for those of you that have been to this event in the past, we've actually added a considerable amount in terms of course material. Let me take you through it. Once again, those dates happen to be May 28th through the 30th. All right, so we're going to have myself, Don Kaufman, the Professor Jeff Bierman, Corey Rosenblum, Tony Rago, Matt Williamson, Brandon Chapman, even special guest appearance by none other than Slim Miller. Again, live sessions are going to now be from, Thursday morning, May 28th. We're actually going to kick off this year's live event where I am going to be doing a 4-hour class specifically on the Infinity Trader. Let me actually take you down to the schedule here just at a glance. Again, Thursday, May 28th, the Infinity Trader, okay? That's going to be from 9 a.m. to 1 p.m. We give you a break in the afternoon, play a round of golf, register for the event. Then we actually jump into cocktails and trading. That's a little bit of a party we do. We actually do kind of a live happy hour. I'll probably do about a 1-hour session during that. Moving into, of course, Friday, kind of our opening ceremonies. Then we actually get into really specific topics. Of course, the Decade of the Trader. I'm going to be talking extensively about the next decade, of course, to come in terms of trade and how we're very likely going to have to alter a huge amount of what we know about finance, investing, and or trading. Obviously, more details. We come on to Battle of the Bands by Professor Jeff Bierman, that's actually talking extensively about Bollinger Bands, volatility bands, and really using countless different technical indicators to be more effective with both entry and exits. We're going to move on to Matt Williamson, Trading Naked. Matt has made a career of selling options premium, specifically selling options premium naked. And he's going to get into a highly detailed session of specifically what he does. Of course, Tony Rago inside the Nasdaq. And for those of you that don't know Tony knows Nasdaq, lives, eats, and breathes Nasdaq futures. Then we come to Brandon Chapman discussing, of course, our engineered economy. This has a tremendous amount to do with central bankers, the International Monetary Fund, GAAP versus non-GAAP, stock buybacks, negative interest rate policy. It doesn't stop there. I'm actually pretty excited about that topic. And then we come into Pockets and Profiles, a guide to intraday trades with Corey Rosenblum. Again, this is just on Friday. Coming into Saturday, all right, we have, again, good trades gone bad. I'm going to actually be doing a session there on learning how, when I say good trades gone bad, well, how to make a bad trade, decent. And we come into our internal risk manager. This is actually from Slim Miller, who's going to get into understanding how we self-sabotage, our level of success. Love, Slim Miller getting into psychology of the markets. Come on to Method, the mindset and mentality of an intraday trader. This is going to be a joint session between Corey Rosenblum, okay, and Tony Rago, getting into really, well, successfully navigating intraday trade. I'm going to tell you right now, I've discussed with both Tony and Corey this particular session. This session alone is worth coming to this course for. It's the little nuances that's actually changed everything and the way that they function on an intraday basis. Then I'm actually going to do a joint session with the professor. It's from charts to trades. This is where we, it's an all-out battle of the quants versus the technical analysis here. We're going to be talking about how to actually take technical analysis and actually merge it, okay, with probabilities. And in a session where Jeff's going to pull up a lot of charts, a lot of technicals, and I'm actually going to build trades around many of his setups. We'll wrap things up over here, of course, the art and science of price action with, once again, the professor, Jeff Bierman. So I also want to let you guys know the entire session, all 3 days, is $9.97. We take care of lunch for you, okay, a couple of the days. If you stay at the hotel, and speaking of the hotel, it's spectacular. I'm going to show you a couple of pictures here momentarily of the hotel here in Scottsdale, Arizona. Obviously, just introducing Corey and Tony and Jeff Bierman and myself and, Brandon Chapman and Steve Miller. Okay, the hotel, absolutely beautiful. This happens to be the 2019 event. We had just over 200 individuals at that event, and we max out. It's all that we can actually host at this particular event. If you stay at the hotel, again, breakfast happens to be included. Take a look at some of the pictures from last year, some of the videos from last year right here on the site. Again, I want to reiterate, it's TheoTrade.com/live. By the way, get to meet all the instructors here. We take shots with them. So I was saying about travel information. You fly into Sky Harbor, that's the Phoenix airport. You can join us. The event venue, it's the Scottsdale Hotel at McCormick Ranch. We have a special rate for you at this hotel after you've enrolled for the event. Again, TheoTrade.com/live. After you have enrolled for the event, we will give you, specific information regarding to stay at the hotel. We have a very large block of rooms. Again, this event is strictly limited to 200 individuals. We've already sold out a multitude of the tiers. You're going to love the hotel. It's smaller. It's a much more boutique hotel. Obviously, it's got a pool. It is on a golf course. It's really, if you will, classic like Scottsdale. It's a wonderful time of the year. It's not too hot yet in Scottsdale. In late May, I'm telling you guys, this is an event not to be missed. Please, once again, join us here at TheoTrade live right here in Scottsdale, Arizona, May 28th through the 30th. Again, it's TheoTrade.com/live.